Welcome everybody to the 10th video of this A to Z FX program. In this video, it's going to be a little bit of a longer video because we're going to dive into what is a pip. We're going to dive into what spreads are. We're going to dive into market structure and breaks of structures. Simple terms for some of you that are a little bit more experienced, but for you beginners or anyone that's sort of struggling on these topics, this is going to be an awesome video for you now because the previous videos, you've learned a lot of theory. It's been a lot of presentation slides. And in this video, we are going to go through the definitions and I'm going to explain what they are and how they're used and why they're important. But I'm also going to jump on the charts and we're going to start to like piece a strategy together. So let's get into it. So what is a pip? Now, a pip stands for percentage in point and is the smallest price move that a given exchange rate can make based on market convention. A pip is based off the fourth decimal place. So for Euro USD, for example, it's trading at 1.1234 and it moves to 1.235. That is a 1 pip move because as you can see, the fourth decimal place here, that is the pip. It's moved 1 pip. So some currency pairs are quoted to the second decimal place, like the Japanese yen pairs, USD JPY, AUD JPY, etc. So 109.50, 1 pip is 109.51. And that's a 1 pip move for those currency pairs because I'm sure you'd get onto the charts and you get quite confused when you're looking at 4 decimal places. I think they go up to 5 or 6 when you're actually looking at the charts, but you don't need to look at those decimal places, just the up to the fourth. Alrighty, so why is it important? Well, obviously they allow you guys to measure the difference in price when conducting your analysis, as well as calculating your potential profits and losses. So pips and being able to understand this is super important because you need it for lot sizing. When you're going to enter a position, you need to calculate how large your stop loss is. Well, you need to understand how large it is so that you can calculate how much you need to risk for that profit to equal, just say, for example, all right, we're going to show you this on the charts. I take a buy position. My stop loss is 4 pips. My take profit for a 4-to-1 is going to be at 20 pips. That's what a 4-to-1 is, right? It's 5 times my stop loss, and therefore calculating my position based off 4 pips. Just say I have a $50,000 account, I want to risk 1%. I need to calculate that. So when I lose a trade, it's only going to be a $500 loss. And with a 4-to-1 trade, if it hits take profit, it's going to be a $2,000 profit. So what is a spread? The spread is the difference between the bid and the ask price of a currency pair. The bid price is the highest price that a buyer is willing to pay for a specific currency, while the ask price is the lowest a seller is willing to accept. The spread is essentially the cost of trading and it's measured in pips. It's also what the market maker collects. We talked about that in previous videos, so you have a pretty good understanding of that now. So this is simply the price your broker is willing to buy the base currency, which is the first currency in the currency pair. So USD JPY, for example, the base currency is USD. The quote currency is JPY. This is the price you will receive if you want to sell the currency pair. And the ask price is the price at which your broker is willing to sell the base currency to you. This is the price you will pay if you want to buy the currency pair. The spread is the difference between the bid and the ask prices. It represents the brokers or the market makers' profit and is a cost or fee that the traders incur when entering a trade. It's how brokers, market makers make their money, or one of the ways. So let's get into, now that you understand that, let's get into market structure. And market structure is a reflection of the dominant party between buyers and sellers and in the form of price patterns. So we're going to get into market patterns as well throughout this video and in future videos, but let's focus on the basics for now so I don't overload you with anything. So an uptrend is bullish. You're going to hear this terminology a lot, bullish and bearish. Essentially, when the market's going up, it's bullish. When the market's going down, it's bearish. Now, what you need to avoid is people, unfortunately, they don't understand the terminology as much, and they don't have that deep understanding of what they're actually saying. So if you just say you're on TikTok, you're scrolling through videos, you come across a live and some trader is saying the market is bearish or the market is bullish, they're referring to, whether they realize it or not, they're referring to the entire asset. So if they're trading USD JPY, they're saying that the entire asset is bullish or it's bearish, which could very likely not be true. So the correct definition is if price has fallen 20% from its highest recorded high in history, that means the entire asset is bearish. And the market is bullish is once price has surpassed the bearish market level, that 20% mark, which we're going to get into. I'm going to show you that on the charts. Alrighty, so the significance of market structure. Market structure is crucial for your pre-market analysis, technical analysis, identifying trends, being able to verify your fundamental analysis, a range of things, but it's direction. You want to be able to trade in line with market structure. And identifying market structure incorrectly can significantly decrease the probability of executing successful trades. And what you need to avoid is deciding what to trade and where to trade, getting that mixed up. So you don't want to overload yourself and really get confused on all these major and minor currency pairs and these crazy setups where you're trading against market structure. At the beginning, pick only a few major currency pairs like GBP USD, Euro USD, AUD USD, NZD USD. They're pretty much two different assets of the same region. So Europe, Australia, New Zealand, very similar. Or you could do GBP USD, USD JPY, USD CHF or CAD, and then AUD USD or NZD USD. It's up to you. But you need to also trade during suitable market conditions, as well as avoiding elements such as consolidation and excessively volatile market conditions if you're trading on the lower timeframes, if you're scalping. Volatility equals opportunity, but it also equals risk. And when price is very volatile and you're trading on the lower timeframes, it can get very messy. And we're going to dive into that now. Alrighty, so information overload. Let's talk about breaks of structure. So a break of structure, or BOS, which you're going to see a lot of people use, that acronym, is when a substantial move in the market has caused price to create a new key level. This signals a potential directional shift in price movement, either creating a new market trend or the conclusion of existing market structure. How do you identify a break of structure? Well, a break of structure occurs when a structural point, such as a higher high, is exceeded by a new higher high. Again, I'm going to get into this soon. How do I know what part of the candlestick identifies a break of structure? Now, a lot of retail traders use the top and the bottom wick of the candlestick to identify a new established high or low. However, I like to use the body, open and close to identify a new established high or low. And that's because most of the price movement has been within that body. That's where the significance lies. The highest wick and the lowest wick, it doesn't have much significance because it's rejected that area. We don't really care about the wick, because if we have a large wick to the downside, that technically hasn't broken structure, because that could have been from a million different reasons, a catalyst, filling an imbalance, doing a range of different things, but it's rejected that area. So I don't want to be selling now, because that just goes against my analysis and my confluences. So let's jump onto the charts now and go through all of this top to bottom. Alrighty, so hopefully my face isn't too much in the way up in the right hand side here. Doesn't look like it is, but we're going to get straight into it now. So I'm going to use GBP USD as an example because it's an easy pair to talk about. But what we're going to talk about right now is pips. I just wanted to be able to show this to you guys. So I'm on the 15-minute time frame, as you can see at the top here. Let's measure this candle. If you guys, this is why I like using the plus indicator, because you can change it up here. Remember at the top left, you can have a dot or a range of different things. I like to have this cross because you can see the horizontal and the X and Y axis essentially. So if I measure the top of this wick, if you are on mouse and keyboard, hold shift, left click, move your cursor to the downside. I might do this right next to the candle so it's easier for you guys. But we can see that this pip is 11.9 pips. That is the pips right there. This is the percentage change as well. But we can see over to the right here, it was at 1.34130. See how there's an extra decimal place? And it moved down to 1.301. So 1.3401, sorry. So that you can see that it's moved almost 12 pips, essentially. So that's how you measure pips. That's what you're looking at. I'll go into the 1 minute time frame and we can look at a candle here. So let's use this momentum candle. The size of this candle is 1 pip. All right. Now I'll use actually a buy position. So let's click it here. So as you can see to the right, this is my entry price. It's 1.3417. Don't need to worry about the 3. I'll move my stop loss to, let's do 10 pips. And as you can see right now, my position's at a 1.65 to 1 risk to reward ratio. So that means if I'm in profit and it hits my take profit, I'm going to 1.65 times my risk. Or now that it's at a 2 to 1, I will, if I'm risking $500, I'll make 1,000. And we can see that 20 pips is at the top here. That's my take profit size. And my stop loss size is 10 pips. This is where my stop loss is at. That's the price point that it's set at. This is my take profit. That's where that's set at. So if I was to take a buy position here, that is what it would look like. Pretty simple. All right, so let's get into market structure. And we're going to use, I'll start off on the monthly to show you the 20% level now. Let me just quickly get rid of this alert. But this is essentially all of the historical price action. I'm not on the premium plan because I really don't need to use it. I use other tools like Bloomberg as well, so I really don't need to use it. But I already know just from all the history that I have trading that this is in fact the highest price point on GBP USD. So on the monthly time frame, I'm going to measure it from the wick because that is the highest price point, and I'm going to move my cursor down 20%. So that is roughly there. What we'll do is we'll put a horizontal ray there. That's the 20% mark. As you can see, price action, even now currently, is below that 20% mark. So GBP USD as a whole is bearish. That asset is long term. Overall, it is bearish. So that's sort of how you differentiate, calling the asset bearish overall or bullish overall. It's not bullish until price comes up to this line and closes above it like that. Now, an indication that price is potentially shifting to bullish market structure is going from the lowest price point instead of the highest and measuring 20% from the low. And as we can see, let me do that again. As we can see, it is above that 20% mark. So I'll do it here. Roughly there. We can see that it's below the 20% mark. It's overall, it's bearish, but it's above the 20% mark from the lowest low, which means it's indicating that price is going to push higher. But again, most of you guys, you're going to be scalping on the lower time frames. It's not too relevant for you, but it is good to just have that overall understanding and also understand your terminology, what you're actually saying. You can't say the asset's bearish if it's not actually bearish, or bullish, vice versa. And we're going to get into our multi-time frame analysis later down the line. But what I might do is I might use the daily time frame just because it's quite simple. And we're going to start at this lower low all the way down here. So market structure, pretend all of this doesn't exist and we're just starting from here. So pretend that all of that does not exist. Oh. And we're starting from here. So we have a low, correct? Now we have a high. This part here, after this little pullback, is a higher low because it's higher than the previous low. If you want to draw a horizontal ray from the low and the high, you can see that it hasn't closed beneath this level, hasn't closed above this level. So it's a higher low. This here, it is not a higher high. This is actually a lower high because it's lower than this high. As you can see, it hasn't broken structure to the upside. Now this, if I was looking to take a buy position, I wouldn't really be the biggest fan of that because it's indicating price is slowing down. It's rejecting this key level. That's a key level. This is a key level. Then we have a higher low because it's higher than this one. Then price breaks structure. This is a break of structure. This is what I was talking about before. That is what a break of structure is, because we can see prices come up, it's closed above the previous high. As you can see here, that is a higher high because it's higher than this high. As you can see how everything's trending upwards. The lows are trending upwards. They're getting higher and higher. The highs are getting higher and higher. As you can see, that's what sort of makes a trend, an overall trend. I'll even draw these trend lines here so you can see. You can see that price is clearly moving upwards. But this is pretty choppy price action here, but we're going to keep moving. So this here is a break of structure. Beautiful. And I might use these circles just to really make it obvious for you guys. And I won't highlight this internal structure, the noise, because it gets a bit messy. Now, this low here, it is lower than the previous low. So this becomes a lower low. It is, in fact, a break of structure or a change of character. You might see this term a lot. CHOC. That stands for a change of character, meaning we went from bullish market structure to bearish. That's showing that price could potentially be moving to the downside now. What's that indicating is price could very well, now that shifted, create a lower high, then break structure, create a lower low, lower high, lower low, and continue going downwards. Because if we look to the left, it has been bearish, but we won't worry about that right now. Now we have a break of structure to the upside, create a higher high, a small higher low, because remember, it's higher than this low. This is higher than this high. Then we have a higher high, because this high is higher than this one. Then we'll have a higher low, because it's higher than this low. Higher high, higher low. I'm just going to copy and paste this. Higher high. Beautiful. And as you can see, that it sort of trends. Sometimes we do have those lower lows like this here, then price changes structure again. But essentially, a higher high indicates that price is going to continue in that direction. That's what it's indicating. It doesn't mean that it is 100% going to go in that direction, but it's indicating that price is going to continue going in that direction because buyers are more dominant in this section, this part of market structure. This is on the daily time frame as well. So it gets a little bit more complicated once we step down on the lower time frames, and we'll go through our multi-time frame analysis in future videos. Let's just keep it basic for now. That's sort of how breaks of structures and market structure works. When price breaks structure to the downside or has a change of character, it's indicating that price is potentially shifting market structure, and it's going to create a lower high and follow that overall market structure direction. And those are what breaks of structures are. So we have one break of structure, second break of structure, it's closed above this level, closed above, closed above, closed above over here as well. So those are all breaks of structures. We're not going to get too advanced with these ones just for now because it's a little bit messy. It's not the best example, but in short, that's how it works. You can see all of the highs are higher than each other. All the lows are higher than each other, right? So go away and practice this in your own time. And the easiest way to do it is drawing these horizontal rays at the lows and the highs, looking for price to break above it. Okay, so we can see we have a break of structure to the upside. Now what I'm going to do is shift this ray to this high. Beautiful. Now I'm going to shift this ray to this low because this is the new range. And I'm going to talk about ranges in future videos as well. But essentially, that's how it works. You're moving, it's had a break of structure to the upside, move your horizontal ray to this high, move your low to the next low. That's essentially what you're doing. So here, where would you move the top and the bottom ray? You'd move it to the next high and the next low because we had a break of structure. So beautiful, move it to the next low and the next high. We can see price broke structure again, vice versa. Follow that along and you'll get really good at identifying bullish and bearish market structure and breaks of structures. Now what we're going to do is look at bearish market structure. And let's start right at the top over here. So let's not look at all this internal noise. Let's just look at the significant and major key levels, which is the highest points and the lowest points. Let's start here. So this is a higher high. Then we have a break of structure to the downside. We can see here, because this was the lowest previous low, that was a higher low, higher high. What people are expecting to happen is once we pull back all in this area, that price is going to continue following that bullish momentum, like over here, that bullish market structure, because that's what it's indicating, that price is going to continue moving upwards and break structure here, because that's what market structure is telling us. But we have a change of character. So this here is a change of character or a break of structure. It's both. but you would call it a change of character because this is the point at which market structure has shifted. And now it's telling us that it could be, it's indicating that price is now shifted to bearish market structure, sorry, and it's going to continue in that momentum, that direction. And look what we get here. We have a lower low, then we have a lower high. So because this high is lower than this one, then what happens is, if we look at this one, we have a lower low because price closed at the body beneath this previous low. And that's what I'm going to use there. Then we have a lower high. It's lower than this high. And remember when we were talking about candlesticks and we're talking about wicks and rejection candles, we can see this is a lower high and we've got rejection candle, rejection candle, rejection candle. Those are all good signs that price is respecting this previous high, which is a key level. These points here, these pivotal points, they're all key levels because those are the highs and lows, lower highs, lower lows, higher highs, higher lows, etc. That's what key levels are. The significant key levels are these large points here where prices change character or there's been a large move before or after significant key level. Right. These would be key levels, but not as significant as these ones. So we then have a lower low, lower high, again, respecting this high, lower low, lower high. Actually, no, we will move it down here just because this is a pretty messy example and this is more internal structure. So if I was to go on the 4-hour time frame, let's put a horizontal ray there and go back to over here, we can see that those little moves were much bigger moves on the 4-hour time frame. They were much larger, significant levels. So that would be more internal structure because it's internal, it's on the lower time frames. If I go back to here, we can see we've got the lower low, which is the significant key level, not these ones. Then we have a lower high, respected this high. You can see all of the highs are getting lower, all of the lows are getting lower. Then we had a potential market shift, but a little bit of indecision. The reason why I say indecision is because the low is not lower than this one. So if I was to look for a sell here, I'd be a little bit cautious because price could reverse here, right? And we've also broken structure on smaller internal key levels here on the lower timeframes, on the 4-hour down. Those are internal key levels that have been broken and this is closed above it. Now we've got a higher low. It's like, ooh, this could be a risk here. But then we have a lower high because it failed to break structure to the upside, rejection, 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 as you can see here. After this candle close, I would be much more confident to take shorts because we had a bit of a scare here. Then we failed to break structure to the upside. We're respecting that overall bearish momentum. Overall, we're in bearish market structure. Then we have a break of structure to the downside again, just confirming that, hang on, we just had a little bit of indecision here, a little bit of consolidation, price got a little bit volatile, and now we're continuing in that bearish momentum. You can get back on the train and follow it. Now we have another lower low, lower high, lower low, etc., etc. Lower high, lower low, lower high, lower low, lower high, lower low. So I hope you guys understand that. I hope you understand breaks of structures. I hope you understand key levels. I hope you understand market structure. We covered quite a bit in this lesson, and I kept it quite brief. Again, as always, if you have any questions, let me know in the comment section below. And if you want me to make additional videos on these lessons, more than happy to do so. I can literally, if you need additional videos, I'll just make the entire thing practical, because I know that a lot of people prefer just the chart work, and a lot of the lessons have been theory, because you do need to understand the definitions, why they're used, why they're important. But in the second videos, if you want, I can just jump on the charts and show you more examples of what this looks like. But go away, this is your homework, go away and identify your key levels, identify market structure, go onto the higher time frames, the daily or the weekly, and just go to, because this is what I struggled with when I first started, was where do I start? Like how do, because if you start somewhere in the middle, you're like, oh, is it bullish or bearish? Like it gets a little bit confusing. Because if you start here, you're like, oh, this is bearish, but then it shifts to bullish, etc., etc. Right at the beginning, just zoom out. You can see GBP USD right here. Any of these points where price is at the lowest, highest or lowest, that's where you look at before a big move to the upside or the downside. So here, if you're looking at bearish market structure, start at this high, work your way down. You're at the lowest low. And then for bullish market structure, start here, work your way up. Again, even here, if you're looking at bullish market structure, start at this low, work your way up. And for bearish, start at this high, work your way down, etc., etc. And then once you're getting a little bit more familiar with things, start somewhere random, right in the middle. Get practice understanding those market structure shifts. Even step your way down to the lower time frames and look at what these internal little lower highs and lower lows look like on the smaller time frames, and then you'll start to get a bit of an understanding of what that looks like. So I hope you all enjoyed this lesson. I hope it gave you some value, and I will see you on the next video. Thanks, guys.